Hello and welcome back to the Note. Today I'd like to go through a very startling anomaly that has developed in the markets since the crisis. It concerns income stocks. If you take a look at this chart, you can see that ever since the crisis started, the market topped out back in October of 2007, the hunt for yield with bond yields held so low has been paramount. Junk bonds, high yield bonds, have actually beaten stocks over that period. But what's interesting is that people have also started looking for their yield from companies, particularly from reasonably strong companies. That red line you see there is Societe Generale's Special Quality Income Index. That looks at the performance of relatively strong companies that pay a high dividend yield. At the moment that it yields more than 5%, and you can see that it's handily beaten the S&P since the crisis. Now, if we take a look at this next chart, you'll see that the performance really is quite startling, because normally you think of high dividend yields as being a value factor. It's something that people who invest in stocks because they're cheap are looking for. But since the crisis, growth, because it's been in short supply, has beaten value, but income has been separated off from other factors and has beaten both growth and value. This is historically very unusual. Now, let's take a look at what's happened in the last few months. This is a chart comparing the Quality Income Index with the MSCI World Index, that's covering developed markets, since the beginning of this year. And you can see that once taper talk started in May, i.e. once the Federal Reserve started to talk about removing its stimulus and pushed bond yields up, quality income has underperformed the rest of the stock market quite dramatically. Now, this is largely about the yield rather than other things to do with those stocks. If we take a look at this chart, which was produced for us by Style Research, a London consultancy, they look at the effect that individual factors to do with stocks have on performance. And you can see that dividend yield was very specifically punished in those 3 months of taper talk. People really wanted to get away from high dividend yielding companies. Other value factors, particularly outside the US, fared much better. So again, we have a very strange situation where income is being prioritized over everything else. Now let's take a look at another anomaly. There is a European version of the SocGen index. This is how that's performed compared to the rest of the European stock market over the last few months. And you can see that while globally quality income has underperformed, in Europe there is no such trend at work. In Europe, people are still paying up to buy quality income. Now, what gives? I don't think this is specifically about a greater demand for income per se in Europe, because Bund yields have, generally speaking, gone up pretty much as Treasury yields. I think it's rather because a dividend yield is in many ways a show me the money kind of investing. If you really care about the dividend yield, it's because you don't trust the other numbers on a company's balance sheet. But when you get paid a dividend, you can feel sure that you're being remunerated. I suspect that the reason that European quality income stocks are still doing well, whereas in the rest of the world they aren't, is because there are still very great reasons for concern in Europe. People are still angst-ridden. They still want the security of high dividends. That means if you really are bullish about European prospects, you think that it is out of the mire, it's probably a good idea to get out of European quality income. The experience from the rest of the world suggests that they are about to be punished.